All right, guys. How we feeling, everyone? Let me know in chat how everyone is doing. It's a beautiful day. We got more things that we got coming up here. Super excited to go over the next one. What was your guys' favorite thing from a last session with Tommy? Let me know in the chat what your favorite thing was or your biggest takeaway. Always like to see what you guys are your favorite takeaways are. 2 to 5 years out. Your 5 minute breaks are hilarious. I'm just re I'm just trying to give the people what they want, right? Seems like you guys are just ready to go, and so I want to match that energy with you guys. Questions to ask your CPA. I know it's like we got to sit down with our CPAs. We got to. It's like that with the little headlamp over your head. Just get them in that interrogation. I feel like that's what we have to do. Break up the year. Yeah, the trust holding company. That's always a classic. Looking forward to this next session. Awesome. Cool, cool, cool. All right, guys. I know people are giving me crap about the 5 minute sessions or 5 minute breaks, but I'm just trying to give the people what they want, right? Trying to go get after it. All right, guys. So, who's ready for this next session? You guys ready? Do you want me to wait a minute, or are you guys ready to go? Please go after it. Ready? Okay. Awesome, guys. So let's get into it. So Tommy walked us through the one big beautiful bill act that passed last July in the last session. He went over some QBI stuff, the bonus depreciation. I know we talked a lot about that, and some of those big wins, right? Now, I've personally spent dozens of hours studying this bill at this point. I went line by line, and there's more in there that directly affects your 2026 taxes that most people aren't talking about. So, in this session, I want to go deeper on these critical topics. The first thing I want to cover is are the provisions that are permanent versus temporary, and then why that matters for your plan. I also want to go a little bit more into the S Corp savings thresholds and when it makes sense to elect that, because I know a lot of people did have questions about that. And then I also want to cover the $40,000 plus state tax deductions that most business owners aren't using. And I know that's a huge topic that people just kind of gloss over, but it can make a meaningful impact, right? So let's get into it. Okay, so in this session, I want to cover first what's permanent, what's temporary, and why that changes your planning. And then I want to talk about some of the provisions that are going to stick around forever. Others are going to expire come 2029 or 2030, and that difference really is going to make a difference when structuring your business, and also putting where your money is going to go. Okay. The second thing, the S corp savings that can save you $5,000 to $15,000 per year. There's a specific income threshold below, and if you stay below it, or if you should stay as an LLC, and if you're above it, you're going to be leaving money on the table. So I'm going to go deeper into that. And then finally, how to deduct more than over $40,000 in state taxes. Okay, so if you're in a high tax state with business income, then there's a legal workaround called PTET. So over 36 states have that, and most CPAs don't bring it up. Okay, so let's go. We're going to go over all that. All right, so here's some critical deadlines. You can take a quick screenshot of this. I'm not going to go super deep into this, but you can take a quick screenshot of this for some of the deadlines that are coming up here. Okay. All right. So back in 2017, Trump signed the Tax Cuts and Jobs Act. So it's nearly $1.5 trillion in tax cuts. He doubled the standard deduction, lowered tax brackets, and also created a 20% deduction for business owners. And most middle and high earners can save between $3,000 to $10,000 per year for this. Now, the catch here was that almost everything was temporary. It was set to expire at the end of last year, and then Congress needed 60 votes to make it permanent. They only had 51. So they used reconciliation, they passed it with simple majority, and then made it temporary. And then later became 2025. And then last year in July, the one big beautiful bill act got signed, and then it made most of those 2017 provisions permanent, and then added new stuff on top of it. So here's what got made permanent. First is that the tax brackets stay at current levels. So the rates that you're paying now, whether that's 10, 12, 22%, those are all permanent. And they were supposed to jump up. And like we talked about in the last session, today is going to be the lowest, in my opinion, that the tax brackets are going to be, right? So that's a huge win. Okay, so for 2026, the 10% and the 12% brackets get an additional inflation boost as well. It's a small change, but it means slightly more income tax at lower rates, which is always a good thing. Now, for the standard deduction, got bumped up and made permanent. So for 2026, 15,750 if you're single, $31,500 if you're married. That's higher than the 15,000 and the 30,000 it was before. Plus, there's a temporary boost through 2028. So you can add an additional $1,000 if you're single and $2,000 for married couples. Now, this matters because the standard deduction is what most people use, and only about 10% of filers even itemize anymore. So if you're not paying massive mortgage interests or donating huge amounts of charity, then most likely you're taking the standard deduction. Also, I know we touched on this a lot here, but the QBI deduction is now permanent. This is huge for business owners. Okay, so it's also known as the qualified business income deduction. What this is you get a 20% deduction on business income from pass-through entities. So think LLCs, S corps, sole proprietorships, and partnerships. If you make $100,000 from your business, you get a $20,000 deduction. That's literally just for existing. Okay, you don't have to do any extra paperwork beyond that. What your CPA already does. Now, this phase in thresholds got increased as well. So married couples is $150,000. It was $100,000 before. And single filers, it's $75,000 now and was $50,000 before. So the new minimum, $400 deduction if you have at least $1,000 of business income. Another thing I want to talk about is the child tax credit got increased to $2,200. It was $2,000 per kid under 17 before. Now it's $2,200. That's indexed for inflation. Okay. And now the refundable portion is permanent. Phase out is $200,000 if you're single, $400,000 if you're married. Now, one of the things that isn't great is that not everything is going to stick around forever. Some provisions expire in 2029, others in 2030. Okay, so let's talk about which ones expire and when. First is the SALT cap. It jumped to $40,000, but only through 2029. Okay, it's a state and local tax deduction. The thing that hit people in California, New York, New Jersey hard is when it got capped at $10,000 back in 2018. But now the cap is at $40,000, but only for tax years 2025 to 2029. In 2030, it's going to drop back down to $10,000. So if you're paying $35,000 in state and property taxes right now, you can deduct all of it through 2029. Come 2030, you can only deduct $10,000. So you're going to lose the $25,000 in deductions. At a 35% federal tax rate, that's $8,750 more in federal taxes every year starting in 2030. Now, the $40,000 cap isn't available to everyone, okay? So if your modified adjusted gross income is over $500,000, then the cap starts to shrink. So here's the formula, okay? So first is you need to reduce the cap by 30% of the amount over $500,000. So let me walk you through an example. Let's say you have $550,000 in income. You're $50,000 over the threshold, 30% of the $50,000 equals $15,000 reduction to your SALT cap, okay? Now at $600,000 of income, you're back at the old $10,000 cap. Okay, so that's just the floor. This essentially creates what's called a SALT torpedo. Between $500,000 and $600,000 of income, you face an effective federal tax rate of 45.5%. You're in the 37% bracket while losing SALT deductions at the 30% per dollar. And all of this expires after 2028. So if your business is making $100,000 and you're still an LLC, you're paying about $6,000 per year in unnecessary self-employment tax that you can't get back. Now, some other temporary provisions from 2026 to 2008 or 2028. So first are the tips. Okay, up to $25,000 deduction for tip workers. Overtime up to $12,500 if you're single, and $25,000 if you're married. Car interest, loan interest is up to $10,000 if it's U.S. assembled vehicles only. And then the senior deduction, additional $6,000 if you're over 65 and income under $75,000 if you're single, and $150,000 if you're married. And all these are going to phase out at higher incomes, all expire after 2028. Okay, so let's walk through some real examples. So first example, let's say you're a married couple, $150,000 W-2 with a couple kids, but you don't have a side business. The standard deduction, we're looking at $33,500. The child tax credits, $4,400. Federal tax, around $9,000. And so the annual savings compared to if the law had expired is going to be between $4,000 and $5,000. The second example, let's say you have $120,000 W-2, $40,000 side business, married with two kids. First, you get the QBI deduction at $8,000. Your federal taxes are going to be around $9,600. So the QBI deduction saves you $1,700 to $2,400 per year over 10 years. That's $17,000 to $24,000 in savings. Okay. Okay, and let's do another example. Okay, last example. The third example is let's say you're single, $200,000 if you're W-2, plus you have $60,000 business income. QBI deduction, 12 grand, federal tax around 51,500. So the QBI deduction here is going to roughly save you $2,800 to $4,400 per year, which is permanent. And so the sweet spot for the S corp consideration could save you another $4 grand to $6,000 here. So the combined potential $7,000 to $10,000 per year. So that's kind of money that can fund a Roth IRA, can accelerate your mortgage payoff if you're into that, or it can even start building your investment account. So it's meaningful money that we're saving here. All right, so some permanent provisions. So this means that you can build 10-year and even 20-year plans now, right? So the S corp election is worth considering now because QBI is permanent, and business structure decisions can be based on that stable law, right? So the temporary provisions require different thinking. Use them while they're here, but prepare for them when they disappear. So for the SALT cap specifically, if you're paying more than $40,000 in state taxes now, you need a 2030 strategy. And that's coming up in a few years, but it's still coming, right? So you got to plan for it. Now, the second part is we need to calculate the S corp break-even point, because most business owners stick with an LLC just because it's simple, right? You get one tax return, there's no payroll, and no extra complexity. And for a lot of people, that's the right call. But if you're a business making over a certain amount, then staying in LLC costs you a lot of money. We're talking $5,000 to even $15,000 plus per year in unnecessary taxes. The calculation changed last summer. QBI is permanent now. And so that means that the S corp decision isn't just some short-term tax plan anymore. Okay, it's a long-term planning. Before the law was passed, everyone assumed that the QBI was going to be going away at the end of 2025. So the S corp conversation looked like this: should we do this for a year or two before the rules change? But now that it's permanent, the 20% deduction is going to stick around. So the tax brackets stay where they are. You're not planning for a couple of years; you're planning for decades here. So that changes the math on whether S corp is worth the hassle. Now, if switching saves you $8,000 per year and you keep the business for 10 years, that's $80,000. Over the course of 20 years, 160 grand. And so the setup costs and annual expenses start looking pretty insignificant compared to that. So when you run an LLC or a sole proprietorship, all your profit is self-employment income. Self-employment tax is 15.3% on all of it. So 12.4% for Social Security for the first $184,000 in 2026, and then 2.9% for Medicare on all income. You can also add an additional 0.9% Medicare tax on income over $200,000 if you're single, $250,000 if you're married. Now, this is on top of your regular income tax, but not instead of it. So as an example, your LLC makes $100,000 in profit after expenses, self-employment tax, $15,300, and then you pay income tax on top of that. But the QBI deduction helps with the income tax, but doesn't touch the self-employment tax. You're still paying 15.3% on the full 100 grand. Okay, so S corp lets you split your income into two pieces, which is your salary and your distribution. So let's talk about the salary piece first. You pay yourself a W-2 wage. It's subject to the payroll taxes of 15.3%. The distribution, the rest comes out as a distribution, right? So it's not subject to self-employment tax for the distribution portion. So let me walk you through an example. So we have the same $100,000 profit, but now you structure it as $60,000 in salary, which is, again, is subject to payroll tax, $40,000 in distribution, which isn't subject to payroll taxes. So the payroll tax on the salary portion is $9,100, and the payroll tax that you save on the distribution is $6,100. So you just save yourself $6,100 per year every single year. The distribution still gets the QBI deduction, so you're getting the 20% deduction on the $40,000, which saves you another $960 to $1,600. Combined benefit here is $7,000 to $7,700, okay, per year. And I know this is really numbers heavy, but this is like really the only way that I can visually see it. And so I apologize in advance, but just that's why this is really important to pay close attention to all the numbers here, okay? All right, so let's run the break-even analysis. So S corps cost money to run. Okay, so you have payroll services, additional CPA fees, state filing fees. You need to make enough that the tax savings outweigh the costs. And so at $50,000 business income, tax savings with reasonable salary split. So let's say $30,000 salary and $20,000 distribution, $3,000 in S corp annual costs, $2,000 to $3,000. Your net benefit here is going to be between $0 and $1,000, right? So it's pretty marginal savings. Probably not worth it unless you're planning to grow fast. Now, at $60,000 to $70,000 business income, tax savings $3,800 to $4,500, S corp costs $2,000 to $3,000, net benefit $800 to $2,500. So this is where it's going to start making some sense, especially if you're trending upwards. Now, at $80,000 to $100,000 business income, net benefit, we're looking at $3,500 to $5,100. This is a clear winner here. And then if you're over $150,000 business income, $7,100 to $10,000 becomes a no-brainer. You're leaving serious money on the table if you don't do this. Now, you can't game this too hard, right? The IRS has a rule. You have to pay yourself a reasonable compensation as W-2 salary. You can't pay yourself 20 grand salary on $150,000 of business income and then take the rest as distribution. Okay, the IRS will reclassify your distributions as salary, charge you back taxes, add penalties and interest. Now, what's reasonable? Okay, because there's always a gray area. So here's how I like to think about it. So first is the industry standards for your role hours. You work and also your qualifications and experience, what you do to pay someone else to do your job. So the general guideline is this: 40 to 60% of business income as salary. So as an example, let's take $100,000 profit, $50,000 to $60,000 salary. For $150,000 profit, you can look at 70 to 90 grand. If you're $250,000 profit, $110,000 to $150,000 salary is pretty reasonable. Okay, you just need to justify if the IRS does ask. Okay, so the S corp distribution also qualifies for the QBI deduction, but the W-2 salary does not. Now, at first glance, you might think, okay, great, I'm going to pay myself minimum salary to maximize my distribution and QBI deduction. But at a higher income level, above $406,000 if you're married, $203,000 if you're single, the QBI deduction has limitations based on the W-2 wages that you paid. So if you're above those thresholds, having higher W-2 wages actually helps you qualify for more QBI deduction. And so for most people watching this, you're probably not hitting those limits. But if you're getting close, talk to your CPA about optimizing salary versus your distribution for both those payroll tax savings and the QBI maximization. So a quick example, let's say $120,000 S corp income. You split it, 70 grand salary, $50,000 distribution. Self-employment tax saved is $7,650. The QBI deduction comes out to 10 grand. Tax savings from the QBI is $2,400 to $3,700. So your total benefit in this example is going to be 10 grand to $11,000. So you compare that to staying in LLC. Self-employment tax on the full $120,000 is $18,360. So the S corp clearly wins in this situation. So here's a setup process. The first step is you need to file form 2553 with the IRS to elect S corp taxation. The second step is to set up payroll through Gusto, ADP, or something similar. It's going to cost about $40 to $100 per month. They handle everything though, which is great. Third step is to pay yourself regular salary. Most do this monthly. Step 4, take distributions from remaining profit. Step number 5 is your CPA is going to file form 1120S and expect your CPA fees to rise just for doing this. But keep in mind that they have to file that form. Now, form 2553 goes to the IRS. Processing takes sometimes 4 to 8 weeks typically, sometimes faster, sometimes slower. We know how our friends are over there. They like to take their sweet time. And then payroll services need 1 or 2 weeks to onboard you. And then your CPA needs time to review the election, make sure it's filed correctly, and then coordinate the timing. Okay, let's break down some of the annual costs here. So the payroll service, $480 to $1,200 per year. For S corp return, you're gonna have to pay your CPA maybe $800 depending on your state. It's a total $2,000 to $4,000 per year. Some states do charge franchise taxes, like California is $800 per year minimum. New York is $25 last I checked, and Texas is based on revenue. Now, here's some of the common mistakes to avoid. Okay, because not paying salary at all. Okay, so the IRS is going to catch this. You'll get audited, and they're going to reclassify everything. So make sure you don't do that. Also, paying yourself unreasonably low salary. $25,000 salary on $200,000 of income usually won't fly. The next thing is missing payroll tax deposits. These penalties rack up fast, so make sure that you let your payroll service handle all that. Also, taking distributions when the S corp has losses, you're going to owe the capital gains tax on that. So your CPA should be making sure that you're tracking basis on that. And also forgetting about state requirements. Some states don't recognize S corp elections automatically or tax them differently. And if your business income is above 80 grand and you plan to keep it going, then S corp probably makes sense. But if it's below that, then it's going to be borderline. Depends on how much you value simplicity versus those tax savings. But if you're above $150,000, you're literally burning money by staying in LLC. The permanence of the QBI changes this from a short-term decision to being part of a long-term tax strategy. So talk to your CPA, run your numbers, file form 2553 to make it retroactive to January 1st. After that, you're going to be waiting until 2027. Okay, so part 3 is the $40,000 SALT cap plus the PTET workaround. Okay, so if you live in California, New York, New Jersey, or basically any high state tax with high income taxes, then the $10,000 SALT cap has been painful since 2018, right? I'm sure you can attest to that. You're paying, let's say, 25 to 35 grand, maybe even $50,000 in state and local taxes, okay, which is insane to even think about. But you could only deduct 10 grand on your federal return, and the rest just vanished. So that's why the Big Beautiful Bill Act changed that, but there's some caveats to it. So the cap jumped from 10 grand to $40,000 for tax years 2025 to 2029. If you're maxing out the old cap, you just got 30 grand more in federal deductions, and at a 30% federal rate, that's over $10,500 in tax savings. Now, the only caveat is it's temporary. So in 2030, the cap's going to drop back down to 10 grand. So the cap increases 1% per year for inflation through 2029. Then the window closes. Here's what qualifies for SALT deduction: state income taxes, local income taxes, property taxes on real estate, or state taxes, or state sales tax. Can do both income tax and sales tax. And most people in high state taxes use state income tax plus the property tax. That combo usually hits the cap. Okay, so let's talk about the income phase out. And this is the SALT torpedo. So the $40,000 cap isn't available to everyone. Okay, if your modified adjusted gross income exceeds $500,000, then the cap starts to shrink. The phase out formula here is you reduce the cap by 30% of income over $500,000, right? So the $550,000 income, again, your SALT cap, $25,000, $600,000 income, your SALT cap drops back down to the $10,000. Now, here's why $40,000 still isn't enough for many people, right? So especially for the California example, let's use that first. Let's say you have $400,000 income in California, state tax, $38,000 property tax on a $1.5 million house, $15,000 total SALT, $53,000, can deduct $40,000, so you're going to lose $13,000 in deductions. Okay, at a 37% federal bracket, losing deductions costs real money. And in 2030, when the cap drops back to 10 grand, it gets way worse. So just take advantage of it while you can. All right. Okay, so let's talk about how the PTET actually works. Now, the normal way without PTET is that your business makes a profit, it flows to your personal return, and then you pay state taxes personally, and then you deduct state taxes, which is subject to the SALT cap. Now, the PTET way is your business elects to pay state taxes at the entity level. Your business then deducts those state taxes as a business expense, and then that deduction happens at the business level, which is not subject to SALT cap. Then it goes to on your personal state return, and you get credit for taxes that business has already paid. Okay, so the net result here is you effectively deduct more than the SALT cap allows. So let's walk through more of the mechanics here. Your LLC or your S corp makes an election with the state to pay taxes at that entity level. So the business makes estimated state tax payments throughout the year, same amounts that you would have paid personally just from a business account. Now, at year end, your business return shows a deduction for state taxes paid. That deduction reduces the income flowing through to you personally. And so on your personal state return, you get a credit for the taxes that your business already paid. You don't get, and so there's no double taxation here. And then on your federal return, your K1 shows lower income because state taxes were already deducted at the business level. And so the state tax deduction never hits your personal itemized deductions. And so the SALT cap, it doesn't apply. So here's an example. Okay, so let's say you have an LLC that makes $200,000. You live in California. Your effective tax rate, state tax rate is about 9%. So you'd owe $18,000 in California taxes. Without PTET, your business reports $200,000 on your K1. You pay $18,000 in California tax personally. You deduct it on Schedule A, which is limited by the SALT cap. Now, with PTT, your business pays $18,000 in California tax directly. Your business now gets to deduct the $18,000, and then your business reports $182,000 on your K1. You get a credit on your personal California return. And so your federal tax savings, 18,000 times the 24% to 37% tax bracket, you're looking at $4,300 to $6,600 saved. Okay. And that's if you were getting zero benefit under the SALT cap. If you already have 25 grand in other state property taxes, then the incremental savings are going to be a little bit smaller, but they're still real. So without PTT, you're limited by the SALT cap. But with PTT, state taxes are deducted at the business level. Okay. The SALT cap doesn't apply. And so the federal tax savings, 18 grand multiplied by whatever your tax bracket is, $4,300 to $6,600. And so if you're already hitting the SALT cap with other deductions, then PTT lets you deduct the full business state taxes instead of losing part of it. So here's why this matters even more. The first reason are that high earners get capped fast. So if you make over 600 grand, your SALT cap is back to $10,000. And then PTT is going to let you bypass that entirely. The second reason is the 2030 cliff. So in 5 years, the $40,000 cap is going to drop back down to 10 grand. So PTT becomes the only way to deduct more than $10,000. So it's better to set it up now. The third reason is you get the stability. The federal SALT cap could change again. The PTT is state law. So states aren't going to repeal it because it benefits their residents and doesn't cost them anything to do it. So over 36 states have it. So including California, New York, New Jersey, Illinois, Massachusetts, Connecticut, and most other states with income tax as well. Now, states without the income tax, like Texas, Florida, Nevada, Washington, they don't have PTT because there's no state tax to deduct, right? So if you're in a state with income tax and have business income, just literally Google your state, pass through entity tax to check to see if your state qualifies. Okay, let's walk through how to actually implement the PTT now. The first step is to verify eligibility. You need a business entity, LLC, S Corp partnership with business income in a state with PTT. The second step is to file the election. Okay, so each state has its own form and deadlines. So just check your state rules. Step number 3 is to make estimated payments from the business instead of you personally. Okay, same amounts just from the business checking account. The fourth step is to let your CPA handle the returns. The state taxes show as a business deduction, reducing your K1 income. You get a credit on your personal state return to avoid double taxation. Now, most CPAs should know about the PTT, but not all of them are going to suggest it proactively. So this is one of those things you want to write down and just ask if they don't know about it. So at $200,000 business income with $18,000 state taxes, the PTT is going to save you $250 per month in federal taxes. So that's $3 grand per year. If you miss the PTT election deadline, you're going to be paying that extra $3,000 when you file your taxes. Okay. And it doesn't roll forward to the next year. So here's some of the common issues that I see. And it's that not filing the election on time, they miss the deadline and you wait until next year. There's also see people making payments from the wrong account. Okay. Payments must come from the business account to count as a business expense. Also, not coordinating with your CPA. Tell them you're electing the PTT so they file everything correctly. And then multi-state businesses need to figure out which states PTT use. So usually your state of residence, but not always. So just make sure to check that. All right. So if you're in a high state tax with business income, email your CPA this week about PTT. Savings can easily be $2,000 to $5,000 per year. If your business makes over $80,000, can run the S Corp numbers, you could see savings of literally $5,000 to over $15,000 per year. Now you have 4 years before the SALT cap reverts back to the 10 grand, right? So if you're currently benefiting from the $40,000 cap, losing it in 2030 costs you $2,000 to $11,000 plus in additional federal taxes per year. The PTT is the primary solution for business owners. Get it set up now. When 2030 hits, you're going to be covered. And so for people without business income paying high state taxes, then options are going to be limited. So consider whether income streams could be restructured through an entity or plan around the $10,000 cap. And if your CPA doesn't proactively bring up the PTT, doesn't know reasonable compensation for S Corps, or tells you your strategies don't apply because you're on a visa when they actually do, you might want to go and look for a new CPA. Okay. Not every CPA specializes in business tax planning. If your business income is substantial enough that your S Corp or PTT saves you $5 grand per year, you want to make sure that someone handles these structures regularly. Okay. So you can literally ask them, say, how many S Corps do you handle? Do you work with PTT elections? If they don't know or hesitate, again, might be time for a new CPA. So let me recap and bring this all together so you know exactly what matters and what you need to know and what to do before year end, right? So first is the QBI deduction is permanent now. Okay, so the 20% deduction on the business income was set to expire. Congress made it permanent. $100,000 business income equals $20,000 deduction, saves you $2,400 to $7,400 per year, depending on your bracket. You can build long-term plays around it. If you're not optimizing your entity structure, you're leaving money on the table. S corp status makes sense. Typically above $80,000 income. Once your business profit hits the $80,000, staying in LLC is going to cost you $5,000 to over $15,000 per year in unnecessary self-employment tax. The SALT cap jumped to $40,000, but it's going to revert back in 2030. Okay, so the cap was raised from $10,000 to $40,000 for 2025 to 2029. Then it's going to drop back down to $10,000 in 2030. So if you're paying $35,000 in state and property taxes now, you're going to lose a $25,000 deduction starting in 2030. Okay. So you have a 5-year planning window. If you're paying more than the $40,000 in state taxes, or you're a high earner who gets phased out, make sure that you know the strategy before it phases out. And then the PTT is going to let you bypass the SALT cap completely. It's going to get the pass-through entity tax. It means that your business pays state taxes at the entity level. The business deducts it as a business expense, and it's not subject to the personal SALT cap. And it's available in 36 plus states. Okay, just Google your state, make sure that you qualify. It's going to easily save you $2,000 to $5,000 per year in federal taxes. And also, really important, if you miss the election deadline, you're going to wait until next year. That's 1 year of savings gone. So just make sure you do that as soon as possible. Also, check your state's PTT election deadline because most require it by year end, but some differ for it. So I put a few examples here on the screen. When the SALT cap drops down to $10,000, everyone in high tax states will scramble to set up PTT. Setting up now means that you're already covered when the cliff hits. If your business makes over 80 grand, email your CPA, ask if S Corp makes sense, run the numbers. Okay. And if you're in a high tax state with business income, email your CPA, ask if your state has PTT. If you're using it, what needs to be filed before December 31st. And then also just make sure you just got one email sent over to your CPA and so that you can get started on this. All right. I know that was super numbers heavy. Okay. But before we wrap up this session, I want to ask you guys for a quick favor if we can. If you got any value from the last 3 days, okay, if something clicked, if you learned strategies you didn't know existed, if this changed how you think about taxes and wealth, then it would mean a lot to me and my team if you left us an honest review on Trustpilot. Okay. So I'm going to have my team actually drop a link in the chat. It takes a couple minutes. We can do it. You can just do it during the break and just tell us what you learned, right? Just be honest. What was helpful, what we can improve. And it's really going to help us improve other people and figure out if this challenge is right for them. Okay. I really, really appreciate you. I'm going to have someone on my team leave a link in the chat. And if you could leave us a review, that'd be awesome. Okay. All right. So over the last few days, obviously we covered a lot. We went through tax strategies, entity structures, short-term rental cash flow, cost segregation, debt elimination. You have the knowledge, right? But here's the truth. Information without implementation is literally just entertainment, right? So what I want to do in the next session is I want to give you your 12-month wealth implementation roadmap. We're literally going to take everything you just learned. We're going to put it in order, what to do first, what to do second, the exact sequence that actually moves the needle, right? Because knowing what to do now and knowing what to do it are two completely separate things, right? So we're going to take a quick few minute break. Okay, I will need a full 5 minute break to break and review. Okay, for sure. Yeah, we'll give you the full 5 minute break this time. Leslie, I hear you loud and clear. We'll give you the full 5 minute break to leave us a quick review, stretch, grab some food, so that way you can go into the next session. So yeah, we'll definitely give you the full 5 minute break. You can stay on this link again. Please leave us a review, and then we'll be back here in 5 minutes. Okay, so let's start the timer here. And we'll see you guys here in a few minutes. Okay.